Welcome to our comprehensive guide on Côte d'Ivoire tax residency. Understanding tax residency is crucial, especially if you're an expatriate, international investor, or someone engaging in business in this thriving West African nation. Côte d'Ivoire is known for being the world's top cocoa producer and features a rapidly growing economy that attracts considerable foreign investments. It's vital to establish your tax status correctly to ensure compliance with local laws while optimizing your global tax position. In this video, we'll explore everything from the requirements of tax residency, its benefits, obligations, and key strategic considerations, ensuring you know what you need to establish your residency in Côte d'Ivoire. Let's dive into the criteria for tax residency in Côte d'Ivoire, starting with the 183-day rule. Much like many other countries, Côte d'Ivoire uses the 183-day rule to determine tax residency. If you spend at least 183 days in the country during a calendar year, you'll typically be regarded as a tax resident. This rule might seem simple, but it requires diligent tracking of your time spent within Côte d'Ivoire. Not just consecutive days count. Shorter visits throughout the year can add up. Therefore, if you're a business traveler or an international professional, keeping precise records of your entry and exit dates is essential for accurately determining your residency status. Beyond counting days, Côte d'Ivoire tax authorities also look at whether you maintain a permanent home in the country. A permanent home can be any accommodation available for your ongoing use, whether you own or rent it. While having a permanent home does not automatically guarantee tax residency, it significantly influences the decision alongside your physical presence in Côte d'Ivoire. If you find yourself in a more complex situation, tax authorities might assess where your center of vital interests lies, essentially, where your personal and economic ties are strongest. This assessment can include various factors, notably family location, your main professional activities, and financial investments, helping to clarify your residency status. Once you've secured your tax residency, it's crucial to understand the tax implications. As a tax resident of Côte d'Ivoire, you will be taxed on your worldwide income, which includes all earnings, regardless of where they were generated. This is in contrast to non-residents, who are taxed only on income sourced from within Côte d'Ivoire. Understanding this distinction is vital for effective tax planning. Côte d'Ivoire utilizes a progressive tax system, where the tax rates vary from 2% to a maximum of 36%, depending on your income bracket. Additionally, residents are eligible for personal allowances and deductions that non-residents do not access, making it all the more necessary to clarify your residency status. As we conclude, establishing tax residency in Côte d'Ivoire involves navigating various legal requirements and practical considerations. The 183-day physical presence test is key, yet it's not the sole criteria. Factors like having a permanent home and your vital interests also come into play. If you're contemplating this move, strategic planning is vital. Remember to maintain clear records of your time spent in the country using tools like Pebbles to ensure you meet the residency requirements while enjoying the rich opportunities Côte d'Ivoire offers. By approaching your residency and tax planning proactively, you're set to thrive in this dynamic economy while remaining compliant with local regulations.